So that question is complex, and I also want to start with the disclaimer of reducing your tax bill isn't always the right idea, given that a lot of people would say that they believe tax rates likely go higher in the future. If we ignore that, then the first question I would always ask someone is, are you an employee of any variety, or are you a business owner? Because depending on the answer to that, it changes what options that you have. I'll start with an employee because that's obviously more simplistic. So as an employee, you're fairly limited on what tax things you can do, but I'll just kind of throw out some ideas. So conventionally, first thing people go to would be like funding a retirement plan, 401k or the like. Most employees are not maximizing the amount that the IRS allows you to put in each year on a pre-tax basis. Most common answer I get to that is their employees are putting in up to the amount that their employer matches. So let's say that an employee is making $100,000 a year and they have a match up to 5% of their annual compensation. Most people are putting in pretty close to that 5%. That's only $5,000 a year of pre-tax contributions or tax savings as far as income is concerned for them. They have the ability to put in north of $20,000 a year on a pre-tax basis right now. So they could essentially remove $20,000 of their income for tax purposes by contributing that to a 401k, ignoring whether or not putting that in before taxes is the right decision for them. Beyond that, the next thing that we would look at would be like a health savings account. So whether you're single or married, it changes the annual amount that you're allowed to put in. That money goes in before it's taxed. It can be invested, used for healthcare related expenses, and so long as it goes in before it's taxed and it's used tax-free. That's a good thing to consider for a lot of people. Flex savings accounts would be another thing to consider. Similar to an HSA, other than it's just used for other types of expenses. So as an employee, there's not a ton of creative things you can do to lower your current tax liability, with the exception of going out and investing in things like real estate. As an employer, it increases your options dramatically. So you can obviously do the same things of maximizing a 401k, HSA, FSA, owning your own building if you're an employer, right? You own the business. That's a way to have a lot more control of your tax liability. But the most common thing people want to talk about when you're an employer is things that are high deductible. So think of a business owner that owns a heating and cooling company. Heating and cooling company need trucks. Current tax law through Section 179 is if you're buying a vehicle and it's for business use, whether it's all business use or partial, you can kind of split it up with help from a skilled CPA, where even as an independent business owner and you have no employees, if you buy a vehicle, especially if that vehicle is over 6,000 pounds, you can deduct the full value of that vehicle. As a business owner, there's all sorts of other things you can do. You can prepay expenses. So a lot of vendors will allow you to say, okay, I have this cost for the next year. They'll even give you a discount if you prepay the next 12 months. The IRS has laws around that, and the most important one to pay attention to is called the 12-month law. Company is leasing a building, and they're under a lease for 2 years. You could prepay both years, but you're only going to get credit for the next 12 months at a time. So there's a lot to pay attention to. You really need a skilled CPA to help you make sure you make the right decisions at the right times. But you certainly have a lot more control of your tax liability as a business owner if you're strategic about it.